Good morning and welcome to another edition of From the Desk of Dan White. I guess the big news in the last month, the election is behind us. So hopefully we can get rid of all the signs on the lawns and the text messages we were getting leading right up to the election. And on Tuesday, last Tuesday, the world waited with bated breath to see which candidate would get elected. Everyone seemed to think it was really important. I didn't think so from a market perspective. But the market seems to think it's great that Donald Trump won. The S&P 500 index was up more than 2.5% on Wednesday. It's up more than 3.5% since Tuesday's closing bell. But ultimately, I don't think his victory means anything for investors. Even worse, I doubt that a guy with a track record of borrowing bigger than Joe Biden, and spending big is anything for financial markets to be thrilled about. Overall, investors should view the election as a non-event for their portfolios. And I think it's kind of dumb if people believe that Trump winning means there's less risk in one of the most expensive stock markets in U.S. history. It's a huge mistake to believe that the market's short-term action in the wake of the election is some kind of signal telling you all is clear for the next 4 years or even the next 4 months. I think the past week of trading, those days are kind of as insignificant as any other 3 days. The market isn't talking to you. There's also the troubling issue of market concentration. Right now, for every dollar you're putting into the S&P 500, like into an index fund, about 35 cents of that dollar goes into the top 10 stocks. Apple, Nvidia, Microsoft, Amazon, Meta or Facebook, Alphabet or Google, Berkshire Hathaway, Broadcom, and Tesla. That's 9 names because Alphabet or Google has 2 classes of stocks. If you take out Berkshire and Broadcom, you're left with the Magnificent Seven, which accounts for nearly 32% of the index. Investors have fallen in love with these stocks and believe that they can do no wrong. And they believe these companies' huge investments in artificial intelligence will make them all the more valuable. Well, according to the Magnificent Seven index, these stocks are now underperforming the overall market. Both the S&P 500 and the Mag 7 peaked in July. In September, the S&P 500 started hitting new all-time highs. But the Mag 7 didn't hit their first new high until the Wednesday after the election. Since the Mag 7 peaked on July 10th, it's up about 3.5%, while the S&P is up almost 6.5%. So, it's kind of crazy that these stocks have grown so quickly and so far that 32% of the index. So you think you're diversified, you're really not. And there's 2 issues that I think are facing long-term investors today. One is the likelihood of a big bear market over the next few years measured against how soon you'd like to retire. A bear market probably isn't a disaster if you're not planning to retire for 10 years or more. You could just ride it out, keep investing, and be happy when the market recovers. In 2022, the S&P fell 25%, a little more than 2 years later. It hit its first new all-time high. In the grand scheme of things, it was just another dip to buy. But what if the decline had been 50, 60% or more? That hasn't happened since the 2008 financial crisis. The S&P 500 peaked in 2007, fell 56%, bottomed out in March of 2009. It didn't hit an all-time high till 2013. The second big issue is seeing mediocre returns for a decade or more. The U.S. and Japanese stock markets have both experienced long periods, as many as 3 decades, where the market returned 0 from the last peak. Each of these periods started out with stocks about as expensive as they are today. Last month, Goldman Sachs reported it expects U.S. stocks to return about 3% a year over the next decade, adjusted for inflation about 1% a year. And the other thing is investors are only human. In a big bear market, it's very hard to watch your retirement fund lose half or more of its value without stepping in and stopping the bleeding. The only way to do that is to sell all your stocks and lock in losses. It's very similar with a sideways market. A decade-long sideways market could prove just as frustrating as a large drawdown, leading many investors to dramatically reduce or even sell their retirement funds because they just can't tolerate watching them go down. So we've seen this song before. And again, I just don't think the election is going to make a big dent into this type of strategy. The Fed, right after the election, the Fed did cut. They cut rates by another 25 basis points, which was fully expected. And absent massive growth in government spending, the U.S. economy is in a recession. We expect lower short-term interest rates and much higher yields on bonds. Office delinquencies are near financial crisis levels. Delinquency rates in commercial office real estate hit 9.4% in October, double the level from a year ago and the highest since the meltdown that followed the global financial crisis. This is going to be a major problem for regional banks. Prices on office towers are plunging by 70% or more. So, the Fed is kind of between a rock and a hard place, and we've been talking about this for years. The debt's an issue, and it's going to become a bigger issue. So, I think it's not a bad time with the market being at all-time highs to take risk off the table. So that's my spin on the market. We want to thank everybody for Google reviews, both for Middletown, Glen Mills, and Lewis. Again, if you have a Gmail account and you haven't yet gone online to give us a review, we would certainly appreciate it. We started the year with, I think, less than 10 and we're over 100. So I really want to thank everybody who's taken the time to give us a Google review. If you are a securities client of ours, if you have a Charles Schwab account with us, we have begun sending out the packets to them. We're sending them out kind of in waves, 25, 30 at a time. They've started to be sent out, so please keep an eye on your emails for documents to sign. There's going to be a DocuSign and a risk tolerance questionnaire that you'll need to complete. And another thing I wanted to mention for all you classic rock listeners, keep an ear out for Dan White & Associates. We've started to advertise on WMGK. So I've had a couple people call me saying they've heard our ads on WMGK. If you're an older person like myself and you listen to 70s rock, you might hear some of our ads on WMGK. And I'm going to be featured in the Good News from the C-Suite coming shortly. I have to go into their studio and tape that as well. We had our 5th annual Pie Drive-By. So again, I want to thank everybody who came to it and dropped off canned goods and toys for tots. You've really helped make somebody's holidays a little bit easier. So I appreciate everybody that participated in our Pie Drive-By. We started that during COVID, you may recall, and we had so much fun with it, we decided to keep it going. And then I want to thank everybody again and keep the referrals coming. I want to thank you for the referrals everybody has sent in. We've gotten about 15% of our business this year strictly from referrals, people that you've introduced us with. And we're going to be having more referral events coming up in the next year. Our first will be our ladies' high tea coming in the spring. Keep an eye out for more information. Again, the way to qualify for these referral events is give us a referral and you get invited to the next event. And just in closing, our Thanksgiving office hour updates. We will be closed on Thursday, November 28th and Friday, November the 29th for the holiday. So, in closing, I want to wish everybody a happy Thanksgiving. I think Thanksgiving is the forgotten holiday. We go from Halloween right to Christmas and everybody skips by Thanksgiving, but it's one of my favorite holidays of the year. It's just a chance to reflect and be grateful for all the blessings that we all have. So I want to wish everybody a happy Thanksgiving and have a great week.